Good afternoon. My name is Daniel Marrero Duran, and this is my research proposal on human AI collaborative investment strategies and interdisciplinary analysis. Introducing this proposal, let's define what we currently know and what this research aims to answer. Artificial intelligence is capable of large and complex data processing and analysis. Capital exchange markets comprise of global equity, stock markets, credit markets, commodity markets, and foreign currency exchange markets. Capital exchange markets are being analyzed by machine learning artificial intelligence models in order to analyze trends and generate investment strategies. Finally, AI is being adopted by the mainstream consumer as a personalized assistant or advisor. This presents a few research questions of interest to pursue. If we're using AI as a personal advisor, is AI going to be used as an investment advisor next? Can AI help newer investors be more disciplined when making investments by educating them on behavioral biases that can lead to poor outcomes? Lastly, could the training data that AI uses be contaminated by behavioral bias or even through communicating with the user? In order to help address these research questions, I read through currently available peer reviewed research articles related to the subject and found evidence to support the following hypotheses. People generally don't trust advice generated by artificial intelligence. This is primarily due to a perception of AI being used as a tool of convenience for quick answers and no visible demonstration of effort. However, this behavior changes when investors become interested in short term trading strategies like swing trading, where you buy and then sell a stock based on overbought or oversold price signals. Investors will use AI for shorter term trading in order to quickly research, strategize, enter, and exit stock positions. In the case of longer term wealth management, people don't trust AI to manage their investments unless there is a human domain expert in the loop with veto authority over AI investment recommendations. Capital markets offer an attractive environment for these shorter term trading strategies because price fluctuations and inefficiencies are largely driven by emotional, behavioral, or biased trading behavior from other market participants. An artificial intelligence investment advisor would be interacted with in a cooperative or collaborative sense due to the technology's deepening personalization and conversational abilities, leading to human users treating helpful technology as a personal assistant or co pilot. However, the training data that informs many publicly available AI models is contaminated with bias. Cognitive and behavioral biases can even be transferred based on how a user communicates and inserts their biased beliefs during interaction with AI. Private and proprietary AI now utilizes a recent advancement in the field of artificial intelligence systems known as agentic AI. Agentic models are able to autonomously monitor market conditions and adjust investment strategies without the need of human intervention. Agentic AI is being adopted by financial firms to increase profits, productivity, and efficiency as capital exchange markets participants. After reviewing the relevant peer reviewed literature, let us further define the questions to answer and the purpose of the research. So, can we use AI as a personalized investment advisor through domain expertise collaboration? There are many openly available models from different companies, so which would be the best at providing investment advice? If markets are not efficient and behavioral market theory is correct, then can we use AI to identify behaviorally irrational stock trading? Can we use AI as a tutor or instructor to help educate and improve the discipline and skill of new investors? Finally, what are the strengths, weaknesses, and key limitations of AI when used as a personal investment advisor? If adoption of AI in the field of finance has the potential to further accelerate, then continuing research is warranted in order to uncover all the possible potential applications of this technology. If we are to discover more potential applications of AI within finance, then an interdisciplinary approach is needed. Interdisciplinary research connects theories and methodologies from other disciplinary fields in order to solve or bring awareness to a large or complex problem. Research within a discipline is usually focused on immediate observations and implications within its respective field rather than identifying the connections and contradictions from other fields. When an investor uses AI to help with creating an investment strategy, there are theories from a range of different disciplinary fields. Artificial intelligence is based on research conducted within the field of computer science. Human to machine communication is a subject being actively investigated within psychology. The field of finance is investigating how AI can analyze markets and automate investment portfolios. Therefore, a human AI collaborative investment strategy requires an understanding of the operation of capital exchange markets from the field of finance, investor cognitive biases from psychology, and deep reinforced learning methods proposed from computer science. Combining our literary findings and the interdisciplinary lens, I propose the following theoretical framework. Human investors are vulnerable to cognitive biases that alter their perception of risk. Biased investor behavior are the results of herding, the disposition effect, blue chip bias, and overconfidence. Herding is where you feel a need to buy a stock because the price is going up or down and everyone is talking about it, so you feel the need to get involved even if the stock is risky. The disposition effect is where you're afraid of losing profits on a stock during a market pullback, so you sell it to realize your gains. Or you refuse to exit a bad investment because you hope that eventually it'll turn a profit in the future. Blue chip bias is similar to herding, except you invest into historically profitable and reliable investments like the top performing companies within the S&P 500. Except these investments may not be safe due to underlying fundamental weaknesses, such as overvaluation, excessive capital expenditure, poor price to earnings ratio, or poor financial fundamentals. Overconfidence is where either through time, experience, knowledge, or recent performance, you begin to justify making riskier investments as you feel confident you can enter and exit an investment position before it goes against you. Artificial intelligence can be used to help a newer investor update their stock portfolio by analyzing the current market environment, generate a strategy based on the personal financial scenario of the investor, and make adjustments to the proposed strategy based on the performance response of stocks within the portfolio overall. This can be a way to help investors use AI to avoid making behavioral or cognitively biased investment decisions during portfolio rebalancing. To collect data that could support the theoretical framework, I make the following proposals. Utilize a range of publicly available AI models like Claude, Gemini, or Perplexity Finance. The use of premium paid for, restricted, or proprietary models are outside the scope of this initial data collection. Provide each AI model with a control prompt and invoke behavioral finance theory to identify irrational trading behavior. Make a note of differences in the specific asset allocation percentages of each AI investment strategy proposal. Compare the AI's proposed investment strategy time horizon for any observable differences. Finally, compare the proposed AI investment strategy to benchmark asset allocation percentages recommended by financial planners. So, in the case of a 30-year-old investor, an appropriate balance would be 90% of equity stocks and 10% of government bonds. My data analysis plan proposes the following AI models to be potentially used: Perplexity Finance, Gemini 3 Pro, ChatGPT 5.3, and Claude Sonnet 4.6, all of which are capable of deep reinforced learning. For the first analysis phase, I'll use a sterile account with no prior conversational history for each AI model in order to ensure no behavioral bias contamination from previously memorized conversations that the AI is able to recall for context. I will then create an investment portfolio appropriate for a 30-year-old adult, which will be 90% stocks and 10% bonds. For the second phase of the analysis plan, I'll have each AI create their own investment portfolio based on short-term investment strategies, current market conditions, and behavioral finance theory. I'll then use an investment portfolio backtesting tool in order to calculate the portfolio's historical maximum profitability and loss. Then, I'll use the data collected from the portfolio backtest and compare it to the historical returns on a popular S&P 500 exchange trade fund, the SPDR SPY. And here are some preliminary data collected. In this case, we issued a control prompt. And then we used a portfolio backtesting website in order to compare the historical performance of the proposed investments. And a link to the full text output of each model, as well as the full results of the backtest analysis, is in the full presentation file. In discussion of the research, I propose the following based on my theoretical framework. We can use AI for real-time portfolio monitoring and rebalancing when applying behavioral market theory and deep reinforced machine learning market methodologies. I set out to investigate the potential applications of using AI to create investing strategies based on theories and methodologies derived from psychology, computer science, and finance. I found that each AI model provided similar market environment analysis for the given control prompt, with each AI proposing a different investment strategy. When backtesting, each AI model was able to construct a portfolio that outperformed the benchmark S&P 500 ETF and the control portfolio. New tools can be created with artificial intelligence that helps educate new investors, as well as make financial firms more productive. In order to train AI to account for the cognitive and behavioral biases present within market participants, an interdisciplinary approach is needed to design new investment strategies. The research is not without key limitations. I do not doubt that future AI models, as well as models inaccessible to the general public, are able to make more personalized and efficient investment strategies for investors. These AI models are typically inaccessible due to the high costs of computation, while some are only available to financial institutions or accredited investors. An investment strategy is only a snapshot in the current time, and historical performance does not guarantee future results. A limitation of analyzing portfolio performance using backtesting. A sudden unexpected event like war, a market crash, disaster, or bank collapse increase market volatility, which could impact the reliability of an investment strategy. In order to account for these unexpected events, more research needs to be conducted on the reliability of AI generated investment strategies and how often changes need to be made due to unanticipated volatility. The potential implications uncovered from the research has led to the emergence of new questions. If everyone starts using AI as a personal investment advisor, then what would stock markets of the future behave and look like due to it? If AI is able to give investment advice better than a human professional, then how could that change the personal assistant relationship we currently have with AI? As AI becomes a common tool in finance, how could that impact jobs of investment advisors and wealth managers within the industry? I intend this research to help educate and inform people who are interested in investing for their retirement, and professional investment advisors who provide client services on how AI is being used for investment advice. To conclude, AI still has limitations to overcome when creating investment strategies. The main intent of this research is to understand AI and the interdisciplinary approach needed in order to utilize the technology for investment strategies. I found that each AI model is capable of providing consistent generalized investment advice, but the specifics of the investment strategy differed between each model. AI could identify and flag cognitively biased trading behavior, but more research is needed. Finally, the reliability of an AI proposed investment strategy will need to be researched long term in order to determine how often an initial strategy proposal must be revised for present market conditions. In connection to my primary pursuits, I made myself the goal of achieving a deeper understanding of what AI is and how it works, what new advancements like agentic AI are, and how we can use AI to help us solve complex and personal investment portfolio problems. AI is being widely used in finance. This could result in people skipping seeing a professional and using AI for investment advice. My aim of this research is to demonstrate my interest in the applications of artificial intelligence across various fields, including finance. This research is meant to be a source of information for new investors on the capabilities and limitations of using AI for investment advice. To close, my research work is a showcase of my interest and capabilities in pursuing AI applications in financial technology at the graduate level.